Hello friends, today I welcome you to this online lecture on goods and service tax, by far the most important tax reform in India. I introduce myself, Rajat Mohan, as a chartered accountant, company secretary and visa qualified professional. I have been doing research in the field of GST for past 5 years and has published a book on GST which is being revised 4 times and published by Bharat Law House. Friends, let's start with why do we need GST? Why do we need GST? The reason is there are a number of issues in our current indirect tax structure. Most important and the foremost problem is the classification disputes, meaning thereby we are not able to ascertain whether a particular commodity is a good or a service. Our constitution has divided the entire taxation regime between central government and state government on the basis of whether the product sold is a good or a service. No man-made item could only be either of the two. Whether you are sitting on a chair or a couch or a table, it always has an element of service. Without service, no goods can take shape, and without goods, no services can be rendered. When the taxation regime would be changed and the power to tax both goods as well as service will be given in the hands of central government as well as state government, then there will be no reason to distinguish between the two. Number of indirect taxes. Indian indirect tax regime has number of indirect taxes. Going forward, you will see that value added tax, sales tax, service tax, excise duty, additional excise duty, luxury tax, entertainment tax, octroi, entry tax, all these taxes would be subsumed under the GST, thereby reducing the number of taxes. When there are number of taxes, that means there are number of acts. When there are number of acts, there are number of authorities required for assessment. One of the major concerns of our Indian businessmen is there are too many authorities to assess the same commodity being sold. For example, in a hotel industry which imposes luxury tax authorities also visit them. Which imposes service tax authorities also visit them for assessment. Which imposes VAT on certain items, VAT authorities also visit them. So these kind of multiple levels of assessment for the same industry is very demotivating for the businessman. Procedures, tax rates, etc. are not uniform across all the states. For a businessman who has multiple offices, it is very difficult to determine the procedure of tax payments, the procedures of tax filing, the rates of taxes, etc. across so many states, which gives a rise to inefficiency and problems with regard to maintenance of accounts and payment of taxes. Probably this is one of the major reasons that foreign investors face while making any investment in India. And with the concept of Make in India, we need to streamline all these procedures and tax rates across India. Credit of value added tax and standards. One of the major problems in current indirect tax structure is even though there are number of indirect taxes, still credit of many of them is not available. Example, luxury tax, entertainment tax, additional duties of custom, surcharges, additional excise duties, octroi, entry tax, etc. These kind of taxes not only add multiple application of the taxes to a single regime, but they also break the chain of credit, because of which tax on tax is applicable and the current indirect tax structure becomes very heavy and inefficient. For the benefit of all my readers, I have drafted an example wherein I have made a comparison between two economies, one economy wherein no credit is available and wherein full credit is available. You can see that the difference between the price of commodity being sold to a retailer in no credit available is 144 rupees and 10 paisa, whereas the same commodity having a cost of 100 is being sold at 132 rupees, and the difference between the two is the taxes difference. There is no difference between the profit. The entire amount of 12.10 is a loss, whether it's tax on tax or it's a dead loss, credit of which is not available. GST, my dear friends, will be a single answer to all the problems of our economy. GST will set up a continuous chain of set off from original producer's point to the point of retailer. Now we come on the topic, what is the aim of GST? What has been the aim of GST? Our governments have thought very nobly, and it says that the aim of GST is to have only one tax, because India is a one country with one rate of tax. By filing a single return and making a single payment, having a single assessment, an assessee is able to do justice to an indirect tax. History of any tax or any government is a very important consideration. Today we'll discuss history of GST in India. It started way back in 2008 when Empowered Committee of State Finance Minister gave its first report on model roadmap for GST in India. Department of Economic Affairs in March 2009 gave the second report, GST reforms and the intergovernmental considerations. The next major report that came in 2009 was the first discussion paper on GST given by Empowered Committee of State Finance Ministers. This report is primarily a state government's view on GST. This is very important to understand how does state governments currently function and what they want out of GST. December 2009, task force set up by 13th Finance Commission gave its very important report on GST. This report primarily discusses about the flawless GST and industrial analysis of pre-GST regime and the post-GST regime, the benefits to various industries and the reasons for imposition of. Next report was given by NCAER in December 2009. Department of Revenue gave comments on the first discussion paper of Empowered Committee of State Finance Ministers in the month of January year 2010. Constitutional Amendment Bill 2011 was presented in Lok Sabha in March 2011. Parliamentary Standing Committee gave its view on 7th of August 2013. Now, my dear friends, standing today, we have a new bill, namely Constitutional Amendment Bill 2014, which was presented and passed in Lok Sabha in December 2014 by Modi government. Now this bill is lying in Rajya Sabha as BJP does not have majority in Rajya. Now we enter into the regime of GST. We'll see what are the provisions of GST as required by GST Constitutional Amendment Bill 2014. Power to levy GST on goods and service tax will be given to both central government and state government, meaning thereby there will be no differentiation of power between central government and state government. Power to levy GST on goods and services will be given to both. In this slide, you will remember that I have talked about the classification disputes. When the power to levy on both is given to both central government and state government, there will be no classification dispute. Next, GST will have two components, central GST and state GST. Central GST will be levied by the central government and state GST will be levied by the respective state governments. Central GST and state GST would be applicable to all the transactions of goods and services made for a consideration. My dear friends, this is a very important line. Government has made amply clear that all the transactions, whether it's a supply, whether it's a sale or it's a stock transfer, if it is done for a consideration, then GST will be applicable. If any transaction which is done not for a consideration, then no GST will be made applicable. Taxes to be subsumed. There are a number of indirect taxes in India, as we have already discussed. Almost all of them will be subsumed under GST, meaning thereby all of these taxes would be scrapped in India the day GST is applicable. Central excise duty, additional excise duty, service tax, additional custom duty, special custom duty, surcharge, cess, value added tax, entertainment tax, central sales tax, octroi, purchase tax, luxury tax, taxes on lottery, betting and gambling, state surcharge and cess. Next, we come on the topic of what would be the tax rate, that is, what would be the tax rate of GST in India the day it is made applicable. Now coming to the task force report. Task force report coined a great term known as revenue neutral rate. As to what is revenue neutral rate, we must understand this. Revenue neutral rate, also commonly known as RNR, means the tax that government collected before the GST regime and the tax the government collecting after the GST regime should be same. So basically RNR is a no profit no loss GST tax rate. It was very astonishing to note that the task force report made a very detailed analysis of the Indian economy and all its sector and all the indirect taxes, and stipulated that only a tax rate of 11% will make the country revenue neutral. Task force report gave a revenue neutral rate of 11% but advised that the GST rate should be 12% in order to cover all the emergencies or assumptions in their report. A Rajya Sabha Select Committee suggested that GST rate should not go beyond 20%. Although the committee never gave any specific rate, but they said that 20% is more than enough. The subcommittee of empowered state finance minister suggested a rate of 27%, but they later withdrew their statement and said we need to rework on this rate. In my very personal opinion, the rate should not be as high as 27%. It could be somewhere around 25%. Constitutional Amendment Bill 2014 suggested no rate of tax, but it very clearly stipulated that there will be number of tax rates in GST. One would be floor rate for basic items, two general rate for all the general items, and three we could have special rate for a very precious item like gold, silver, bullion, etc. We might also have band rates. Band rates means where government does not fix a particular rate but gives us a band of rate 3% to 5%, which could be further subdecided by each state. Now let's come to the topic of valuation. Under GST regime, how will valuation be done? My dear friends, valuation is a matter which will form shape only when the rules are being framed. Currently, government has not stated anything on the valuation part, but I myself feel that valuation will be on the basis of consideration paid. Tax credit. Tax credit is the most ambitious part of GST. In real sense, GST will change the entire mechanism of tax credit. As you might remember, the GST will have two components, CGST and SGST. CGST shall be allowed to be taken as input tax credit only against the payment of CGST, and SGST will be allowed as credit only against the payment of SGST, meaning thereby cross utilization between CGST and SGST. This is a small chart which very clearly states that output CGST and output SGST can be set off only against input CGST and input SGST respectively. Now coming to the tax credit. The problems related to accumulation of credit on account of refunds would be avoided. But even if refund or adjustment of CGST or SG has to be given, it will be completed in time bound manner. In the case of exporters, taxpayers purchasing capital goods and taxpayers paying input tax at the rate higher than the output tax rate. Now let's see an illustration on tax credit. This illustration was given by Empowered Committee of State Finance Ministers, in which they very clearly showed that in case of a supply of goods from manufacturer to wholesaler to retailer, the effective GST will only be applicable on the value added. You will get the entire credit on input cost and you need to pay entire tax on your sales price. They very clearly showed that there will be no breakage of credit chain, and if you look at the last point, retailer, then retailer is required to pay tax of ₹1 only, whereas wherein the value added is ₹10. The net GST that goes into the pocket of government is the final selling price into the rate of tax, which is 10%. So the net GST going into the pocket of government is 16 rupees. Please note here that the rate of GST 10% is assumed rate of GST. It's not the final rate of GST. Now let's start the new topic of exemptions. Exemptions. All public services of government, including civil administration, health services, formal education provided by government schools and colleges, defense, paramilitary and other government departments would be covered under the exemption of GST regime. However, no exemption will be available to railways, post and telegraph, commercial departments, public sector enterprises, and banking and insurance sector. Any sale of unprocessed food article which is covered under public distribution system would be exempt regardless of the outlet through which it is being sold. Educational services provided by any non-government schools and colleges. Please mark here, my friends, educational services provided by only schools and colleges would be exempt. Educational services provided by tutors and teachers and playway schools. Coming to our next topic of special products, there are three products which need a special mention, that is tobacco products, petroleum products and alcoholic liquor for human consumption. We will discuss these topics in a greater detail in next slide. Seen separately by you all. First start with alcoholic liquor for human consumption. This is covered in the exception of GST definition under Article 366 12A of the Constitutional Amendment Bill of 2014. Thereby, no GST will be applicable on alcoholic liquor for human consumption, and if at any stage Government of India wants to cover this under the regime of GST, then again a constitutional amendment will be needed. Other than GST, as GST will not be applicable, there is no tax to be levied by central government on alcoholic liquor. Only state sales tax would be applicable on alcoholic liquor for human consumption. Now coming to petroleum products. Petroleum products are covered under the definition of GST, but GST Council is yet to decide the date for and on which GST will be applicable on petroleum products. Power to levy excise duty is given under list 1 of Constitution. Thereby, even after GST is applicable on all the products all over India, GST will not be applicable on the petroleum products. Instead, excise duty will be applicable as it is today, and state sales tax will be applicable as it is today. Now coming to the third item, tobacco and tobacco products. Tobacco and tobacco products are again covered under the definition of GST. However, power to levy central excise duty is also given to central government, meaning thereby tobacco will have two levies. One is GST and one is central excise duty. However, no state sales tax will be applicable. Now, I have prepared a small table for all the products discussed before: alcohol, petroleum and tobacco products. Alcohol is not covered under GST, petroleum is covered under GST, but the date of applicability of GST would be decided by GST Council in future. Tobacco is currently covered under GST. No central government taxes would be levied on alcohol, but yes, state government will impose taxes on alcohol. For petroleum products, both central and state government will impose taxes. For tobacco, only central government will impose. Now, coming to the next topic of interstate transactions. For all interstate transactions, integrated GST, commonly known as IGST, would be levied by central government. State government would not be authorized to levy any tax on any interstate transaction. The rate of IGST will be equal to central GST plus state GST. In other words, we can say the rate of IGST will always be equal to GST. IGST will apply to all interstate supplies of goods as well as services. Person making the sale would charge IGST and then he can utilize the credit of IGST, CGST, SGST in the same order to discharge any output liability arising on IGST. Let's take an illustration on IGST. Let us assume that there is a seller in Delhi who sells some goods of rupees 1000 to a buyer in Gujarat. Now, on his interstate invoice, he'll charge CGST, SGST or IGST. He'll charge IGST. IGST will be equal to 10% plus 10%, that is 20%. So IGST charge is equal to 1000 into 20% equal to 200 rupees. Reducing CGST 50 rupees, reducing SGST 70 rupees, final IGST payable in cash is rupees 8. Now friends, our next topic is exports. Exports will be extremely simplified. Right now in our country, exports are being exempted by central government and state government. This exemption will no more continue. But don't worry, you don't need to pay any tax on exports, meaning thereby exports would be zero rated. All the exports would be chargeable to GST but at the rate of 0%, meaning thereby there will be an automated procedure to get refund. Once your output liability is 0 and your input liability is 1000 rupees, then you will get automatic refund under the scheme of GST. You ideally would not be needed to file any separate form for getting the refunds, as it is applicable in many countries: Singapore, Australia, Canada. These countries does not have a scheme of exemption. In other words, these countries has a on same basis. We might also discuss the applicability of GST on imports. One thing is very clear: on imports, basic custom duty is applicable and will be applicable. It is not being subsumed. But both central GST and state GST will be levied on import of goods and service tax. Full set off will be allowed of GST paid on import of goods and services. There is a new concept of additional tax which is being coined under GST Constitutional Amendment Bill 2000. Levy of an additional tax on supply of goods and only goods in the course of interstate trade or commerce is to be collected by Government of India for a period of 2 years, which will be given exclusively to the states from where the supply of goods originates. Tax cannot exceed 1% of the total consideration. My dear friends, although this term is being coined under GST Constitutional Bill 2014, but still it has some problems. Whether the supply of goods will cover stock transfers also, until now there is no clarity, but as the bill states, It seems that government intends to tax stock transfers also. Secondly, no input tax credit will be available for the additional GST paid by a additional GST would be applicable to the supply of goods which originates from a particular state. My dear friend, you must notice that this term supply of goods which originates needs detailed rules and principles which will be formulated by the Parliament of India after the formation of GST. However, I bring into light a very crucial and important problem which I can see today. In case a commodity is supplied interstate, like in this case I have taken an example of GST Council. This is the most important and basic provision under the entire GST regime. You can say GST Council will be the top on which the entire structure will be balanced out. This council will be required to make a recommendation to the union and states on the principles of levy, apportionment of IGST, principles for the place of supply rules, goods and service tax exemptions, threshold limit of turnover, special provision with regard to several states, recommendation on the date when GST will be applicable on petroleum products, any other matter which the council may. My dear friends, one point is to be noted that GST Council will not only make recommendations but has the power to make decisions. Total half of the members will constitute a quorum at GST Council. Every decision of GST Council shall be taken with a majority of 3/4 of all the members present and voting. Central government will have a weightage of 1/3 and all state governments put together will have a weightage of 2/3. Meaning thereby, even if all the state governments come together to decide a single decision in their favor, they cannot do so without the assistance of central government. This structure will ensure uniformity. One of the very basic topics on GST will be the procedural aspects with regard to returns, with regard to payment, etc. The payment of tax will be through a combined payment and transaction reporting statement in form number GST1. GST1 would detail all business to business transactions related to sales. GST1 would be common to CGST and SGST, which would be filed on monthly basis while making payment of tax. Now coming to our next topic of administrative issues. This is a very important topic and it will decide as to who will administer GST. That is, who will make an assessment in GST, whether it will be a state government or a central government. We have three options. Central government and state government has concurrent power to levy GST, so they should also have power to make an assessment on an assessee. meaning thereby both the governments will have equal rights of making an assessment, so they both can visit your office for an assessment. To me, this is the most illogical interpretation of GST and will defeat the entire purpose of GST. This should be avoided in order to avoid litigations and harassment to assessors. Option number 2, central government and state government can divide assesses between themselves based on various criteria of turnover, paid up share capital, etc. Option number 3, for all the assessees who are having offices in multiple locations could be administered by central government, and of assessees who are having only single office in a single state could be easily administered by the respective state government. These are the three options available. To my mind, option number 1 is illogical and a mix of option 2 and 3 would be taken. Before going, I'll also highlight some taxes that will not be subsumed and will continue to be made applicable even after GST. Number 1 is stamp duty. Number 2, basic custom duty. Third, excise and state VAT on petroleum products, excise on tobacco products, and state VAT on alcoholic liquor. Last but not the least, the news on GST. GST rate will be between 25% to 27%. GST bill is still stuck in Rajya Sabha. Congress is creating fuss on GST. Dear friends, I thank you from the bottom of my heart for giving me a patient hearing, and I seriously hope that I have been able to make justice to the concept of GST. And even after this, you face any problem in GST, I have given you my mail ID, I have given you my website. You are most welcome to send me your queries and I will reply as soon as possible. Thank you.